Assalamu alaikum. Welcome to lecture 16 of tax. This is the first lecture introducing you to corporation tax. Corporation tax are tax paid by companies. So the previous two taxes, your income tax and capital gain tax that we have covered, are paid by individual taxpayers. Corporation tax is paid by company. So in this lecture, we are going to go through the computation part and the administration part. So starting with profits, companies are taxed on their profits. Then what is the accounting period? See, for capital gain tax and income tax, we focus on tax years, which runs from 6th April to 5th April, but not for companies. Companies run on accounting period. They will be taxed based on their accounting period. Then, what is the basis of assessment for companies? Difference in tax treatment between companies and individuals. Then, the taxation of distributed profits. When you're distributing the profit, how it is taxed. Dividends, employee remuneration, loan note interest, and patent royalties. Then, the computation. UK profit, pro forma. Computation, basic rule, marginal relief, effective marginal rate of tax, short accounting period. See, the short accounting period we have covered in income tax also. But there is no what? Long accounting period for corporation tax. So short accounting, that is for CGT, when you're calculating CGT. Now, accounting period straddling 1st April 2023. Associated companies. Then, self-assessment companies. How does companies complete their tax return? Then, online submission. Payment of corporation tax. Then, claiming for the tax relief, the procedure, the time limit. Then, enforcement. When you are submitting late. Failure to return tax records. Interest on tax paid late. Penalties for incorrect returns. We have covered the administration part of income tax, and most of it are very similar to our companies also. Exception are there. There will be few differences, but most of them, the administration part, are similar to what you have studied in your income tax administration. Then, choice of business medium. This is very important. Why? Because based on this, what you are choosing, your tax, the way you calculate, will differ. So it's either you can operate as a sole trader or a limited company. Remember, if you are operating as a sole trader, you pay income tax. If you are operating as a limited company, you pay corporation tax, that we are going to cover in this lecture. Then finally, we are going to conclude with the syllabus. Which part of the syllabus did we cover in this lecture? The summary, the entire lecture, and which technical articles you have to read based on this lecture. So first we distribute the profits, corporation, we compute, then comes the assessment, claiming, then enforcement, then the choice. Now, profits. So UK resident company, I repeat, UK resident company has to pay corporation tax on their worldwide taxable total profit, worldwide, for an accounting period, not for tax year. Okay, and you have to be a UK resident company, a company that is a resident of UK. So as explained in lecture 1, a company is resident in UK if it is incorporated in UK or it has central management and control of the company is exercised in UK. One of the two. So taxable total profit. This word you will see when you are referring to corporation tax. Company profits. So let me recall back. Under income tax, it was your taxable income. Under capital gain tax, it was your chargeable gain. Here it is taxable total profit. You see, it's the same thing, but the terms changes. So on your taxable total profit, you apply the percentage corporation tax and find the tax. Remember, your total profit includes both your income, both the gains. This income and gain I've covered in the previous lecture. Lecture 1 to 11 focusing on income, 12 to 15 focusing on gains. The detailed part as explained. Here you have to know, now you add both. That arises in UK. And after that it is reduced, you deduct qualifying charitable donation. So limited companies have to prepare accounts using accrual accounting basis. Cash basis is not available to limited companies. Remember, when you are an individual taxpayer, you have the choice, cash basis, accrual basis, but for companies always accrual basis. Now, accounting period. The accounting period for a company means that is the period when you will be charged to corporation tax. So, for corporation tax, your accounting period can be at any length not more than 12 months. Okay, where the period of account is 12 months or less, accounting period is automatically the same period. See, period of account, okay, period of account and your accounting period, often they are the same but not always. Okay, so your period of account is 12 months or less. If your period of account is 12 months or less, your accounting period will be same. It will be the same period of account. If your company period of account exists, if your period of account is more than 12 months, it's called long period of account. When you are having a long period of account, you have to divide this into two separate accounting periods. First, 12 months, and second, the balance. Let's say you are having 18 months. So first 12 months is the first accounting period and balance 6 months is the next accounting period. Then you will calculate the corporation tax. For each accounting period, you will calculate the corporation tax. Now, no other combination of accounting period is acceptable, only this. The issue comes when it's a long period of account. Short period of account, there is no issue because your period of account and accounting period is same. But if it's long, more than 12 months, there you have to do the work. Now, so additional rules apply for long periods of account. See lecture 17. Lecture 17 will cover that. Next lecture. Now, an accounting period must begin either when the company starts trading or immediately after the end of the previous accounting period. And they must end on the earliest of 12 months after commencement or end of the period of account, or end of at the commencement of winding up of the company, or when the company ceases to be liable to corporation tax, whichever is the earliest your accounting period ends on that day. Now, what is the basis of assessment? Actual. Whatever the profit that arises in your current accounting period are assessed for that period. So the tax year which applies to individual, that is 6th April to 5th April, is irrelevant for corporation tax. For corporation tax, it's the financial years that are important. This will cover in the section 4 in this lecture. So now, what are the difference between companies and individuals? Now, you know very well about individuals. Even though about companies, you do not know so much at this stage, at least with individuals, you know. Okay, so you will be able to relate. So the difference tax treatment assessed. If you see, the tax treatment of companies that are assessed to corporation tax are similar in many ways to the tax treatment for individuals. Individuals are assessed to income tax and capital gain tax, whereas corporation tax is for companies. Okay, these are the differences. First difference, companies are assessed on profits on accounting period. Individuals are assessed on both income and gains on tax year. Then, there is no personal allowance for companies. I repeat, no personal allowance for companies. Third difference, chargeable gain for companies will be assessed to corporation tax, but chargeable gain for individuals will be chargeable to capital gain tax. So gain, corporation tax, For individuals, it is capital gain tax. We have finished the individual part, CTD, from lecture 12 to 15. Now we will be working on the chargeable gain for companies part. No annual exempt amount for companies. No personal allowance, no exempt amount also. Now, companies are entitled to one thing that individuals are not entitled, that is indexation allowance. This will cover in lecture 18. Because, let me tell you, the 5 lectures from lecture 16 to 20 will be focusing on corporation tax only. Okay. So try to relate this lecture with 17, with 18, with 19, with 20. They are related. Okay. So these are the 5 differences. Next, second part of this lecture. So first part was we have just introduced you. Now, taxing the distributed profits, dividends paid. So if a company is paying the dividend, what is the tax treatment? When a company distributes profit by way of dividend to shareholder, this amount is paid out of profits after corporation tax. Okay, from the profit you are paying, after you are paying corporation tax, you are paying this amount. So dividends paid are an appropriation of taxed profits, not an allowable expense for tax purpose. You cannot deduct it from your income as an expense. They are not expense. It is an appropriation of profit. So this distributed profits are chargeable to tax again in the hands of the shareholder. When the shareholder receives this, they will be receiving it as a dividend. So for shareholder, it will be taxed as a dividend income using the tax rates of dividend that we have covered in lecture 1. So see example 1 for this. Now, dividends paid. So the tax treatment for shareholders who are personal taxpayers and tax treatment for shareholders who are corporate taxpayers, they're different. If you are a personal taxpayers, we have finished this part, you will be subject to income tax at the dividend rates, 8.75 for basic, 33.75 for higher, 39.35 for additional. This is based on your income level, and you will be allowable to first 500 of your dividend being taxed at 0%, the dividend nil rate ban. So you can look back to lecture 2 for this. Now, coming to the tax treatment of corporate shareholder. This is companies. So for shareholders that are companies, because dividends received has been paid out of the profit that has already been subject to corporation tax. So the dividend income will be exempt from further corporation tax. Already it was paid. Corporation tax was paid and then that profit is given to you. So now they will not tax twice. So dividend income is exempt in the hands of an investing company. The one who is investing, in his hands dividend income will be exempt. Now, employee remuneration, loan note interest, and patent royalty. These are the 3 ways your profits could be distributed. So we are finished with the dividend. Now we are moving on to the next type. There are various types how profits could be distributed. So these amounts paid by companies are tax allowable business expense. That means you can deduct them as an expense. Employee remuneration, loan note interest, and patent royalty. These 3 things you can deduct as an expense from the company, but not dividend. So employee remuneration will be subject to income tax when employees receive it. Loan note interest and patent royalty, they are subject to income tax if it's in the personal taxpayer's hand, and corporation tax if it's in the hand of the corporate taxpayer. Understood? Now, because there's a potential for double charge to tax, so to avoid that, any potential double charge to tax is avoided. Why? Because employee remuneration, loan note interest, patent royalties payable all count as allowable expense of the paying company for corporation tax purpose. For corporation tax purpose, remember, if this is incurred by the company, they are all deducted as an expense. Why? Because if you see your employee remuneration, for company you deduct as an expense, but it is chargeable to income tax in the hands of the employee. Same for loan interest and patent royalty. They are subject to income tax in the hands of the depending based on the taxpayer, corporate or personal. So they do not charge it twice. That's why when you're calculating the company profit, that time these three are deducted as an expense. They are not taxed twice. So patent royalties received relating to the company trade are included in your trading income. Remember, if your royalty, patent royalty is relating to the trade, it is included in your trading income. Patent royalty received that is not related to your trade will be under miscellaneous income. Now, example 1. So here there's 100,000 shares, £1 each, pays a dividend of 10 pence per share. So profit before tax has been given, corporation tax is at 25%. Okay, now deduct get. So from profit after tax we are going to deduct 10 pence of 100, which is 10,000. Here they have shown the working. So we'll deduct this dividend from profit after tax, and this is your retained profit. Okay, now so company has only one shareholder. There are two things. One, if the shareholder was a personal taxpayer, what are the tax consequences of dividend? And if he's a corporate shareholder. If he's a corporate shareholder, remember, it's very easy. 10,000 dividend that is received is exempt. Okay? Exempt from whom? The receiving company. So the receiving company is not liable to pay corporation tax on this dividend income. Coming to individual. Individually, you have to calculate. What is a dividend? 10,000. Okay? And at 10,000, let's assume you are a basic rate, higher rate, and additional rate taxpayer under these three scenarios. And this, of course, will be taxed at nil, 0%. So your taxable 9,500, 9,500, 9,500 taxed at different rates. At basic rate, at higher rate, at additional rate. So this will be your income tax payable under three different rates based on the level of the income. Okay. So from this, what are you understanding? If it's a dividend, it is better if you're operating as a company. If company receives it, it's better because you don't have to pay any tax to corporation tax. Whereas if the shareholder is a personal taxpayer, there's a tax incurred. Moving on to the third part of this lecture, the computation part. UK profit. Okay, a UK resident company will be assessed to UK corporation tax on its worldwide income and gains. Remember, it's on worldwide income and gains. But for your tax, only profits that arise in UK will be asked. Okay, worldwide the overseas income will not be asked in your tax level, but in your ATX, advanced taxation, there you have to deal with overseas part also in addition to this. So we'll keep the overseas part for ATX. Now, taxable total profit will be covered in more detail in lecture 17. But here summary is given of what is included. So you can see this from the pro forma. Let us see the pro forma. Let's say it's a ABC company preparing their corporation tax for the year ended 31st March 2025. Remember, it's for the accounting period, not tax year. So we start with trading profit, property business profit, non-trade interest, all the types of income. Then chargeable gain. Remember, after you add your income profit, you get gains. So this trading profit we have covered in the previous lectures. Okay, when we were doing income tax, property business profit also I've covered in lecture 3 or 4 when we were doing income tax, and chargeable gain I've covered in capital gain tax. That's why you need the previous knowledge of your income tax and capital gain tax for the preparation of your corporation tax. So one is related to another. You can't just study one in isolation, they are interrelated. For example, if you don't know how to calculate your trading profit or your property business profit or your chargeable gain, you will not be able to do corporation tax also. So there's a note 1 to this. We'll see later what is this note 1. Then add all the types of profit income. You get your total profit. From here you deduct qualifying charitable donation. Initials are QCD. Okay. Note 2. Then you get your taxable total profit. If they do not give you any qualifying charitable donation, your total profit will be equal to your taxable total profit. But most of the time I have seen in the paper they give you the QCD. Now, so we tax calculated at rates. Rates are set for the financial years. Okay, so corporation tax we calculate. There's a note 4. Now, so we'll go through the notes. First note was for chargeable gain. So this is your taxable amount of gains. This is for the company's accounting period. Okay, taxable amount of gains for the accounting period. We'll cover this in lecture 18. Now, second, QCD, deducted from total profit, income plus gain. Remember, total profit means add your income and gains and then deduct. So, they are tax deductible from the profits of any company, irrespective of the types of activities that the company is engaged in. You can be a trading company, you can be an investing company, doesn't matter. This QCD you have to deduct from the profits of any company. Note 3. So as stated in section 2.1, dividends received from your other companies are exempt from corporation tax. That's why they do not form part of your taxable total profit also. Ignore them. But they will be given to you in the question. Okay. Next, the corporation tax liability. So tax payable, as all corporation tax is collected by self-assessment. There is no deduction at source for corporation tax. This you have to calculate and you have to pay to HMRC through self-assessment. Now, part 4. So we are computing basic rules. What are the basic rules? So your financial year, this is for corporation tax. Okay, company, it runs from 1st April to 31st March every year. So we take it as financial year. For example, financial year 2004. You have to see the starting. So this starts on 1st April 2024, ends on 31st March 2025. This is 2024, right? So starting also will be 2024 financial year. But 1st April. 1st April is fixed, 31st March is fixed. There in individual it is 6th April to 5th April. Here 1st April to 31st March. Now, so the rate of the corporation tax for FY 2022 and FY 2021 was 19%. This was the single rate. It doesn't matter what is the company's profit. Company's profit could be anything. This was the single rate that is used. But for the financial year 2024 and 2023, remember we are in the financial year 2024. That's why this is relevant for us. There are now two rates of corporation tax. What is it? A small profit rate, which is 19%. This applies when company's augmented profit do not exceed the lower limit, that is 50,000. It has to be below 50,000. What is this augmented profit? I will explain you shortly. Okay. Just for now, keep it. Company's augmented profit should be less than 50,000. Then it is known as small profit, and so small profit rate will apply. And main rate, which is 25%. This applies if your augmented profit is 250 or more. 250,000 or more. Remember the limit and the rates. Now, so the lower and the upper, this will be proportionally reduced for the short accounting period and also according to the number of associated companies. Remember, the more associated companies you have, the more and more amount will reduce. We'll see this in section 4.6. What is an associated companies? Now, what is augmented profit? Augmented profit are company's taxable total profit. This we have calculated from the pro forma. plus, remember we have ignored the dividend, now add the dividend plus dividend received. But this dividend received has to be what? Outside the group, not intra-group dividends, outside the group. Okay, dividends from 51% group companies are excluded. Any, remember the group companies. If you are in a group, then any dividends you are receiving among the members of each group are excluded. They are not taken with your TTP. But dividends received from outside the group, outside this associated companies, you will add. Now the rates are given. Rates of corporation tax in your exam. So let us go through example 2 and 3. Example 2, they are having a TTP of 40. So corporation tax is what? 40,000. Look at the year 31st March 2025. So this is FY 2024 because it starts from 1st April 2024 to 31st March 2025. Look at the starting, not the end. Starting will tell you which financial year is it. So 40,000 is less than 50,000. FY 2024 has two rates, small profit rate and main rate. 50,000 is less than, 40,000 is less than 50,000. So we'll apply the small profit rate, that is 19% to this 40,000. Example 3, they are having same year but 800. So more than 250, main rate 25%. Okay. Now, marginal relief. What is this marginal relief? Marginal relief eases the transition from the small profit to the main rate. So because you are now moving from small to main rate, this happens when, remember, marginal relief you will not get in all the cases, only when your augmented profit by now you know, with your TTP you add dividend received from outside the group. So augmented profit when it falls between 50 and 250, not less than 50, not more than 250, between this, then only you will get the marginal relief. Why? Because between this there's a change, there's a transition. Suddenly you are paying 19%, now you start paying 25%. So to ease that transition, they are giving you a marginal relief. Now, so the corporation tax is calculated at the main rate 25 with this figure, then reduced by the marginal relief. You will calculate the corporation tax at 25% only if it's between 50 and 250,000. But this, whatever you calculate, that corporation tax you will reduce by the marginal relief. This is the formula for calculating the marginal relief. Get the upper limit, okay, minus your augmented profit into a standard fraction into TTP divided by augmented profit. Remember, if you are not having any dividend, then your TTP is equals to augmented profit. So remember this formula. Most of the time there are very high chances of the examiner giving you this question, the marginal relief part. So the standard fraction for this financial year 2024 is 3 divided by 200. It's fixed, memorize it. If no dividend, then you can omit this part. This part can be omitted, this fraction TTP divided by augmented profit, because it will be 1 only. If they are same amount, so if you divide the same figure, let's say 10 divided by 10 is 1, 5 divided by 5 is 1, so you can omit. So then it will be, formula will be upper limit minus augmented into standard fraction. Now example 4. So here TTP is 200 and dividends from non-group companies 30,000. That means you have to add this 30,000 because they will always mention whether it's a group company or non-group company. So what will be your augmented profit? TTP 200 plus dividends from outsider 30. So 230. If you see this 230 is more than 50 but less than 250, you are going to get marginal relief. So calculate what is your TTP 200. Not on 250, not on 230, on 200 because your TTP. Remember, corporation tax are always on TTP, not TTP plus dividend, which is augmented profit. Do not calculate corporation tax on augmented profit. Most of the students make this mistake. They start calculating corporation tax on augmented profit, which is 230. No, it's on TTP. So 200 into 25, which is the main rate. Then you deduct the marginal relief. How? By the formula. So what is your upper limit? 250. What is augmented? 230. What is the standard fraction? 3 divided by 200. Here you have to do this fraction. TTP divided by augmented profit because they are not the same. TTP is 200, augmented is 230, 261. So this is your corporation tax. Okay. Now, activity 1. Here it's 150. Dividends from 51% group companies is 50,000. Remember, since it's from 51% group companies, ignore. So your TTP will be equal to your augmented profit in this case, which is 150,000. So this 150,000 is between 50 and 250. You will get marginal relief. So calculate 150 to 25 and deduct the relief. Upper limit is 250, augmented is 150, and the standard fraction. So this is your corporation tax. Now, effective marginal rate of tax. If there are no dividends, then the effective marginal rate of corporation tax on the profits that fall between this is 26.5 if it's between 50 and 250,000 if no dividends. This provides an alternative way to calculate the corporation tax without calculating the actual marginal relief. Why are they giving you 26.5%? They are saying rather than calculating that tax on the main rate, deducting marginal relief, just calculate the actual marginal relief based on this percentage. So the profits up to 50,000 will be taxed at 19, remainder will be taxed at 26.5. There is an alternative way of calculating this. That's what they are just showing. So now we'll calculate this based on the alternative method. TTP is 180, no dividend. Okay. So now let's calculate using the two method. But if you see the corporation tax 43950, 43950, whatever method you use is same. So first we'll take the method that we have been introduced to. 180 into 25, deduct the relief. Upper limit is 250, augmented is 180, standard fraction. Since no dividend, augmented profit is equals to taxable total profit. That's why we did not multiply that by that fraction. Now using 26.5%. So calculate 50,000 into 19, then add. What is your TTP? 180. So your TTP minus the lower limit, which is 130, multiplied by 26.5%. Same corporation tax. They saw that. See in the exam which question are they asking. Are they asking effective marginal rate of tax, or just they are telling you, or you have to go by the this is method 1, this is method 2. See to that. Are they asking you the marginal rate of tax? If they are not asking, then you can go by the first one. It's your choice. They saw that. You are not wrong, you will get full marks. Now, short accounting periods. If you are having a short accounting periods, your lower and your upper limit will also be reduced proportionately. Okay, short means less than 12 months. Accounting period less than 12 months. Now, example 6. So here, before you calculate corporation tax, always reduce the upper and the lower limit for short accounting period. So you are having a TTP of 90 for 6 months and dividends of 5,000 from non-group. Deduct the TTP. First, upper and lower. What is the lower limit? 50,000. But 50,000 is annual, 12 months. Take it for 6 months, it will be half of 50. Same upper limit, half of 250 is 125. Understanding? So what would be augmented profit? Do not scale down your TTP or dividends. They will remain 90 and 5. So it's 95. And this 95 is between 25 and 125. So marginal relief applies. We'll go by the first method, not 26.5%. So take 25% into 90,000, that is TTP, and deduct marginal relief. So 125 is your upper limit now, minus augmented profit 95 into 3 divided by 200 standard fraction, and TTP 90,000 divided by augmented profit 95, and get the corporation tax. Accounting periods straddling 1st April 2023. Separate calculations are required on a time apportioned basis if the company's accounting falls partly into the financial year 2022 and partly into 2023. You see, it happens, it can happen. And very likely you might be given a question like this only, where your financial year are falling partly here and partly in the next year. If this happens, you have to be careful. Why? If there is a change in the corporation tax among the 2 years, then you have to do it separately. If it's the same tax rate, then that separation is not required. But most of the time I've seen the rates are different, that's why separation is required. They give that type of questions to test your knowledge. Okay, of course examiner would want to make it more complex. This is because the rates of corporation tax changed for this financial years from 2022 and 2023. This is the time when the change took place. If it was 2023 and 24, no issue, no change, is the same. For 2021 and 22, no issue, no change. Only from 22 to 23, there's a change that took place. In 2022, there were one rate. 2023, there are two rates. You understanding? So now, 2022, only single rate, that is 19% was applied. But 2023, you are given a marginal relief also. So it is easier to time apportion the overall marginal relief calculation rather than apportioning each separate figure. What are they saying? Rather than apportioning each figure separately, apportion only one figure. That is your marginal relief. Time apportion is marginal relief. However, a fully time apportion approach is safer when you're dealing with a short accounting period. So example 7. Let us understand this with example 7. So here, Sandin is having a TTP of 210. Dividend from non-group is 10. Accounting period is 3 months. So 3 months falls in the financial year 2022. The remaining 9 months 2023. So you're only going to get the marginal relief for the 9 months. Now, first calculate your augmented profit. TTP is 210. Dividend is 10. So it's 220. Now, this 220 is between your lower 50 and upper 250. How do you know that? See, you have to apportion this also and this also. So you have to apportion it for 9 months when you're in 2023 and 3 months for 2022. Okay. So understand. First we'll go see, first is first in first out. Financial year 2022. We'll finish off with the 3 months. What was the TTB? 210. Take it into 3 months and apply 19%. Because financial year 2022 only one rate, 19% on TTP. Then you add the financial year 2023. Again take TTP, take it for 9 months and apply 25%. Because it is above the upper limit. How do you know that? TTP 210. If you see the augmented profit is 220. So what is the upper limit? 250. Take it for 9 months is 187,500. So it's above this. Your 220 augmented profit is above 187,500, the upper limit. So you apply the main rate 25%. We have done it. Now deduct the marginal relief. Sorry, this is an alternative method. In this, sorry, it has to be between the lower and the upper. Okay, so this 220 is between 50 and 250. Remember, when we are taking short and long, we are apportioning the TTP. Not the upper and the lower limit. So here the upper is 250 minus augmented into 3 divided by 200. TTP is T to 210 divided by augmented into 9 months because it's only for 9 months, and get the corporation tax. But this 322, there is an alternate method you can find out. Here we did not apportion the upper and the lower limit. It remained 50 and 250. That's how augmented profit 220 is between them. That's how you got the margin. Okay, because marginal relief will apply to the financial year 2023. It's there for the whole year, that 50,000. Now, so alternatively, the marginal relief could be time apportion by apportioning the augmented profit. So if you are taking 220, take the augmented profit 165. When you're taking the augmented profit, when you're taking 220, you can't compare it with the apportioned. You have to take 50 and 250 only, because in that case you have to apportion the augmented profit also, like here in the alternate way. You apportion the augmented profit for 9 months, then upper limit also you take for 9 months, lower limit also you take for 9 months. That's how you're going to get. Compare. You have to compare like with like. You can't just apportion one thing and keep the other thing as it is. So once you apportion, you see upper limit is 187,500, augmented is 165. It's between lower and upper. 3 divided by 200. So this is TTP. 157,500 is the TTP. How do you know? You have already calculated here. Divide by the augmented. You have apportioned everything line by line. So here, this method, second method, you have apportioned everything line by line. TTP, augmented profit, upper limit, lower limit. For 9 months, that's how you got. That is one way. Second way is this, the first method. You only apportion what? Your TTP and your marginal relief. Not your augmented profit, not your upper limit, not your lower limit. So same marginal relief only you are getting 322 and 322. That means your answer will be same. Now 8. So example 8. Short accounting periods straddling 1st April. See here, it is not short accounting period in this case. Example 7. It was just accounting period starting 1st April 2023, but it falls into different financial year. But here it is short accounting period, that is starting 1st April. So TTP is 105. This is for 6 months and the 30th June. Now, so 3 months, first 3 months, Jan to March, falls in financial year 2022. Next 3 months, April, May, June, falls in the financial year 2023. Now, we'll see whether marginal relief applies or not. So, when you're taking it, you only have to take out of 6 months, you have to take for 3 months. That is financial year 2023, the augmented profit. So, no dividend. So, no dividend means augmented will be equal to your TTP. It's 105 into 3 divided by 6. So, this is your augmented profit, 52,500. Lower limit will be 25,000 and upper limit will be 125. So 52,500 falls within these two limits. That's why you will be eligible for marginal relief. Now take TTP 3 into 6 into 19. Then for 23, 52,500, this is at 25%. And then deduct the marginal relief. Since your dividend and augmented are same, we are avoiding this part of the fraction. So it's just upper 125 minus augmented into 3 divided by 200. And hence your corporation tax. Accounting period starting 1st April. So 2023 and 24, they are same. So there is no significant to an accounting period starting 1st April 2024. Remember, if it's only 1st April 2023, when the periods are straddling, that is the issue. Other dates, there is no issue. Only 1st April 2023, only 1 year. So corporation tax will be calculated in the same way as for any other accounting period if it's between 2023 or 2024. Now moving on to the associated companies. Now, how we have changed when in short accounting period or different financial year, the limits, upper and lower limits, same way for associated companies also, lower and upper limit changes. Associated companies are this. Companies that are associated means if they are under the same control. That means shareholding of more than 50%. Companies that are only associated for a part of an accounting period, let's say only 6 months they have been associated, but they will be taken as an associated company for the whole of that period, not only 6 months, 3 months, for the whole year. And dormant companies. What is dormant companies? Dormant companies are not counted as associate companies because they are not carrying on a trade or a business. And for your associated company purpose, it is irrelevant where a company is resident. Irrelevant. Therefore, companies which are resident overseas, you can include them as an associated company. But do not forget to include the parent company in the number of your associated companies. Students often forget this. Activity 2. So let us do activity 2. You have been given alpha as the following shareholder. So do not forget to count alpha as one company. You have beta, Charlie, Delta, Echo, Photos, Golf. Let's say B, C, D, E, F, G. So A has B, C, D, E, F, G. Okay. 30, 60 and remaining are all 100%. This is 60. All these are what? More than 50% except one which is less than 50%. So A acquired E on 31st December 2024 and disposed of his shareholding in Delta on 1st Jan 2025. The other shareholdings has been held throughout the year. So you have to see E and you have to see D. Both are 100%. Fox is a dormant. The other companies are all trading. So you can't take F. G is a resident overseas. G of course you can take. Explain which companies are associated. So B straight away is not associated because less than 50. It's 30%. C 60. C yes. D disposed of his shareholding in D on 1st Jan 2025 before the year end. It has been disposed. D. So we'll see D. And E. E was acquired on 31st December 2024. Even if it's acquired just 3 months before year end at 31st March 2025, it is taken as a whole year. So E yes. F no. G yes. For now you know with alpha 1, Charlie 1, E, G. There are 4. For now you know there are 4 companies which are associated. You only have to see now which one. Delta. Delta sold its shareholding on 1st Jan 2025, 2 months before. So let us see for Delta whether it will be counted or not. Yes, it is counted because even if it is sold, it will be taken as if it was associated for the whole year. They have taken Alpha, Charlie, Delta, Echo, and Golf. Delta is taken. So there are 5 associated companies because they are all trading companies and Alpha has more than 50%. You have to explain if a company is not associated, why they are not associated. B is not associated because it's very straightforward, less than 50%. Fox is not associated because dormant. G is associated, even though it's a resident overseas. So if they are associated for the part of the accounting period, whether you are buying or selling in between the year, whole year they are associated. Example 9. So here you have been given TTP 70, 2 associated companies. Okay. So because you have 2 associated companies, remember with LAM there will be 3. So you have to divide by 3. Lower limit divide by 3, upper limit divide by 3. So 70,000 is more than the lower, less than the upper. So you are eligible for marginal relief. What rate you will apply for 70? TTP 25 and deduct the marginal relief. No dividend. So your upper minus the TTP into 3 divided by 200. Now, activity 3. Same. 85. This is for 9 months. And one associated company. Okay. One associated company. So you have to divide by 2 because with CAT, one associated. So you have to divide it by 2. And prorate by 9 divided by 12. Both the upper, this is the upper, this is the lower. So this is your lower limit 18,750, upper is 93,750. Your profit is in between 85. So you are eligible for marginal relief. 85 into 95. This is your upper 93 minus TTP into 3 divided by 200. And hence your corporation tax. Remember that 85,000 is already for 9 period. They have adjusted it for 9 months. You don't have to apportion again. If it was for 12 months, then only you have to take 9 months of 85,000. Now, fifth part of this lecture, self-assessment. So a company is required to calculate their own tax liability, submit an annual tax return and settle the tax liability at the date. Unlike personal, all companies must submit online. For companies, they must submit their tax return and pay electronically. But for individual, there's an option, either paper or online. Now, completion of tax return. HMRC will formally notify a company of the need to submit a self-assessment return. Company must file its return by the later of these 2 days, 12 months after the end of accounting period and 3 months after the date on which the notice requiring return is served. Completion of the tax return. So for long periods of account, returns are submitted for each accounting period within 12 months of the end of the second accounting period, because both returns and computations are based on the same set of accounts. For example, a company preparing accounts for 18 months, that is ending 31st December 2024. So they have to prepare 2 tax returns, one for 30th June 2024, because 12 months, the other one is for remaining 6 months, 31st December 2024. And both returns must be filed by, see, you have to see this, the later date. Second accounting period, you have to calculate 12 months from that date. So both return you have to file by 31st December 2025. Okay. But your payment dates will be due. Company will have 2 payment dates, one for each accounting period. One for 30th June 2024, the other one is for 31st December 2024. The payment dates are different. This will cover in section 5.4. Then, companies can amend also their return at any time within 12 months of the filing date. Same like the individual. HMRC can correct error within 9 months of the actual filing date. Actual filing date as opposed to the prescribed. Not the prescribed filing date, actual filing date. 9 months from there. HMRC are given less time than the companies. Now, companies must retain the records that are supporting the tax return until the 6th anniversary of the relevant filing date. From the relevant filing date, 6 years. However, if HMRC requests an additional return before the 6th anniversary, the time limit is extended until either the compliance check is completed or the time limit allowing HMRC to start such an inquiry has expired. Okay. Now, if no return is filed, HMRC can issue a determination of the self-assessment, same like for individuals. This determination can only be stopped if the company submits an actual return and settles their tax. Return must include a copy of the company's financial accounts with the company's self-assessment of the amount of corporation tax. Now, online submission of the tax return. Tax returns of companies must be filed electronically using a standard electronic format called Inline E-Extensible Business Reporting Language. The short form is IXBRL. The format not only applies to the tax return and computation, but also the accounts submitted with them. This is a worldwide standard electronic language which applies computer readable tax to business data. So IXBRL means that accounts and the tax computations are prepared with embedded. Remember, this is not visible to the human eye. unless uncovered. So embedded computer readable tax which permit secure, fast and rigorous computer analysis of the data contained in these documents. This is about the format. Now, companies can apply with IXBRL rules by using either computer software that has been issued by HMRC. Here, automatically your accounts and tax computations will be produced in the required format. You don't have to set up the format. Automatically it will be done in the format. But it is only suitable for small companies with simple financial affairs. That is a limitation. Or one of a range of the commercial software packages that is designed to deal with more complex financial situations. And that is which is validated by HMRC. So this all are required for your MCQs. Okay. They will not ask you these questions, how your IXBRL operates, on how it works. They will not ask all this. This is only for MCQ part and it is available for companies. So now moving on to the payment of corporation tax for small companies. When you're paying corporation tax, make sure there are two varieties. Either companies are small or either companies are large. If companies are large, they pay by installments. If the company is small, they pay by a certain date. A due date is given. For companies which are small, that means their profit is below 1.5 million. Then they will pay their corporation tax due 9 months and 1 day after the end of the accounting period. Remember this date, memorize this date. Small companies, 9 months, 1 days after the end of the accounting period. For example, if your accounting period end is 31st December 2024, 9 months will be September and 1 day after that. So 1st October 2025 is your due date. For the purpose of determining small or large, what should you compare with this 1.5 threshold? Your augmented profit. This you should compare with the threshold. These are calculated like this. So TTP plus non-group dividend income is your augmented profit. This you know. Now, threshold is 1.5 million is. This threshold can be reduced if you are having a short period of account and associated companies. Two things, short period of account or associated companies. In this case, threshold is divided by the number of associated companies including the taxpayer company at the end of the immediately preceding accounting period. Now, some exam advice. This 1.5 million threshold is included in your tax rates in the exam. For any question involving quarterly installment payment, number of associated companies will be given. Okay. Now, large companies. Large companies means those companies which exceed the threshold. They must pay their corporation tax in installments, usually quarterly. How? First installment is due 6.5 months after the start of the accounting period, and the last installment is due 3.5 months after the end of the accounting period. So for a 12-month accounting period, if you are paying quarterly, that means after every 3 months, there will be 4 installments. This will be due on the 14th day of each month. So first one is in the 7th month of the accounting period. Then 10th month. Next another, so first month after. So all these are in the accounting period. 7 months of the accounting period, 10 months of the accounting period. Third one is first month after following the end of the accounting period, and this one 4th month following the end of the accounting period. But the date will be 14th only. 7 month of 14, 14th of 10 month, 14th of first month of 10th of accounting period, 14th of the 4th month, like that. Now, definitely you will understand this with a question. So now, for other accounting period, the number of installment depends on the length of your accounting period as follows. Remember, it depends on the length of your accounting period. If it's only for 12-month period, you are having 4 installments. But what if it's less than 12 months? So for your accounting period, if it's more than 9 months, but less than 12 months, number of installment is 4. You could have 10 months, 11 months, 12 months. So 10, 11, 12. 10 month, 11 month, 12 month. All 4 installments. If it's more than 6 months, but less than 9 months, 7, 8, 9. 3 installments. And then more than 3 months, less than 6 months. So 4, 5, 6, 2 installments. And if it's 3 months or less, so 3, 2, 1. For the first 3 months, 1 installment. You understanding? Now, for short accounting period, the first installment is due on the 14th of the 7th month after the start of the accounting period as normal. This is normal. That's what we have done. And subsequent installments at 3 months interval after every 3 months until the last installment, which is due on the 14th of the 4th month after the end of the accounting period. So for accounting period of, let's say, 3 months or less, if you take the 7th month after the start of the accounting period, it's also the 4th month after the end of the accounting period. And in this case, the full liability would be paid on the 14th of that month. If you're not understanding all these months, don't worry. With questions, you will understand. All installments except the final one are based on an estimated current tax liability calculated by the company. Remember, these installments that you are paying are on estimated. Okay, so not the actual liability of the previous tax year, as applies for income tax. For income tax, you are paying the actual liability, but here it is based on an estimated figure. Okay, so maybe sometimes you might pay more since it's estimated. Sometimes you might pay less. You might get a repayment, or you might have to pay an additional this thing. So to avoid any interest charges, this should not be understated. That means when you are doing the estimation, you should not underestimate the figure. Otherwise, you have to pay interest charges for paying low tax. And your overpayments, if you have paid more, it will be refunded with any additional interest supplement to it. Installments for a short accounting period. So 3 divided by number of months into the estimated corporation tax liability. If you want to know what are the installments, divide the 3 by the n into the distance. So n is your number of months in the accounting period. Now, there are some exceptions where they don't have to pay my installment. A company that becomes large for the first time or resumes being a large company after a period of not qualifying as one. That means he was a small company, then he was a large company. After that, due to some circumstances, he was not a large company, he was small. Then again, he became a large company. So where he resumes after a period of not being a large company, he again becomes a large company, will escape this quarterly settlement. That means you don't have to pay by this quarterly settlement. If provided profits for your relevant accounting period do not exceed 10 million and it was not a large company in the previous accounting period. So the 10 million limit is restricted by number of associated or short accounting period. This also will reduce. Same like the 1.5 million limit. Now, a company is also excused from the installment payments if the corporation tax liability in the current or the year before that is less than 10,000. This 10,000 is also prorated for short accounting period. Now, example 10. So in example 10, we are going to go through the quarterly installment. So Anon has 1.35 million TDP. Okay, it's for the full year. These are the dividends you have received. 60% or 50%. And TDP for 31st March 2024, this is 2025, was 3 million. You see, it's more than 1.5 million. So with this TDP, you'll be adding what? Non-group dividend income. What is non-group dividend income? This one, this 250. Why? It's 5% versus 60%. This is in the group. You do not add it in the TDP, it's ignored. But this one is outside, only 5%. So 250 you add with TDP, this is your augmented profit. Augmented profit you compare. 1.6 is more than 1.5 million threshold. So it's a large company. So they will pay by installments. Okay. As it exists 1.5 million, regardless of any associated companies. Okay. If you see, in the previous year, he was having a TDP of what? 3 million. This is to understand the previous year. So Alon was a large company in the previous year also. So they can't escape the quarterly installment. They have to pay. So they will be corporation quarterly installments. When are they going to pay? Now you will understand this better. If you get the first installment right, next all 3 installments automatically will follow on. Just add 3, keep on adding 3 months to it. So first installment, 7 months from the end of the accounting period. When is your accounting period end? 31st March. April, May, June, July, August, September, October. October is the 7th month. 14th of that month. So 14th of October 2024 is the first date. Add 3 months. November, December, January. Add another 3 months. February, March, April. Add another 3 months to April, May, June, July. You see? Because it was a 12-month period, so 4 quarterly installments. 14th. The date is 14th only. Now, example 11. This is for short accounting period. Okay. It's a large company, prepares accounts to 31st July. 8 months. Okay. 31st March 2025. So for 8 months, 1.5 million is the corporation tax liability. Now, remember, you have to pay. They will be due in installments. Okay. It's not for 12. It's 8. How many installments will be there for 8 months? Remember that table? 3 installments. 3 quarterly installments. Okay. So how will you get the corporation tax in installments? That formula. 3 divided by number of months. So 3 divided by 8. So here it is 3 divided by 8. Here it is 3 divided by 8. This is the balancing. 3 months. So out of 8, it is 3. Okay. It's corporation tax is 1.5. So 336, the balancing 2 month. 2. This is the balancing figure. 1.5, 1.4, 1.5. So these are your corporation tax which are due in installments on 1.5. Now, procedure. So now we have moved on to claiming for the tax relief. The calculation part is over. Now we are moving on to the theory part. So here the procedure, you have to claim within a specified time limit unless they are required to be included on the tax return. You have to do it in a writing, same like for personal taxpayer. So claiming for capital allowance, losses, group relief or repayment must be quantified. You have to quantify them and you have to make it in the tax return. This is the same for an individual taxpayer also. The only difference is an individual are not eligible for group relief. This is only for companies. Okay, now the time limit. Unless there's a time is 4 years of the end of the accounting period. This is same for the individual also. 4 years from the end of the tax year. Here it is from the end of the accounting period. Now, enforcement. So as explained in lecture 11. Lecture 11 explained you the for income tax. The administration part for income tax. Same administration only now is for corporation tax. We just change the type of the tax. Everything else remains the same. Interest, penalties. So here penalties will apply. Whether it's personal, whether it's corporate. If you are submitting your tax return late or you are not keeping the records or taxpayer is failing to notify HMRC of a new source of income. So the late payment will incur interest charges along with the penalty. And any repayment that you are getting. Okay. So repayment may be added to a repayment made by HMRC. Repayment supplement. Okay. Interest on repayments of the tax. You will add it with the repayment. Now, so when you are late for submitting a tax return, corporation tax return, that means after the filing date, you have passed your filing date to submit the tax return, what are the penalties? It is based on the interval since your filing date, how long you are taking. The longer the time you are taking, the more late you are, higher the penalty. So up to 3 months, penalty is 100. More than 3 months but less than 6, 200. More than 6 but less than 12, 200 plus 10% of tax for the relevant accounting period, unpaid tax. 12 months or more, 200 plus 20% of any unpaid tax for relevant accounting period. This table you have to remember, okay, the time limit and the penalty. Now, the 100 and the 200 can be raised to 500 and 1000 also if the late filing is third or subsequent consecutive occasion of late filing. That means twice you have filed late. The third time you are filing late, remember this 100 becomes 500, 200 can rise up to 1000. Consecutively you have filing late from after the second time, third or consecutive, subsequent, okay, and it has to be consecutively, one after the other you are filing late. Now, failure to retain the tax record, maximum penalty is 3000. This is for individual also, for the income tax records. Now, these are the business records. Your annual accounts, statement of profit and loss, statement of financial position, bank statement, cash book, sales ledger, purchase ledger, invoices, records, delivery notes, petty cash book, relevant business correspondence. Same for the income tax also that we have gone through. Same list. Now, interest on tax paid. Interest will be given to you in the exam. It's fixed. And the interest runs from the due date until the actual date of payment. Where the tax is paid in installments, these rules apply to each payment. That means each payment is installment. First payment, second payment, third payment, like that. So interest or repayment. So interest on a repayment of tax will run from the original date of payment until the day that the repayment order is issued. Generally, when you are paying an interest, remember interest on the late paid tax is a not tax deductible amount. You can't deduct it as an expense. But interest that you have received on repayment, it is tax free. Thank God. For corporation tax by installments, opposite rule applies. This is why you have to know for the individual first to compare the difference with the company. What is it? The interest is taxable. That interest is taxable as a non-trade interest that you are receiving for repayment. That is also taxable under corporation as a non-trade interest because you have not used it for trading purpose. And interest that you are paying on a late tax, you can deduct it as an expense as against non-trade interest. Penalties for incorrect returns. So there is a standard penalty only. And this single penalty applies to all taxes: income tax, capital gain tax, inheritance tax, VAT, and corporation tax. So you can see lecture 11 for this. Now, the last part of this lecture, sole trader. So choice of a business medium. This question is a very, what do I say? I think it's the favorite topic of the examiner because it often comes in your exam. Okay, frequency is very high for this to come. Better to operate as a sole trader or limited company. For this, you have to differentiate among the two. Okay, so an individual can choose. Remember, if you are operating as a limited company, you can save on your tax and NIC. You can save on this, but not necessarily. And there will also be more of an administrative burden. Yes, you might save on them, but administrative burden is more when you're operating as a limited company compared to sole trader because there are more complications, more rules to follow, stricter, right? Now, a director has more flexibility in how they can extract profits compared to a sole trader. And they may try to choose a more tax efficient combination of salary and dividend. Whether it is better to take it as a salary or a dividend if it's a sole trader. Now, exam advice. A comparison of business medium could feature in your higher skill question. This type of questions normally involve more than one syllabus area and may involve more than one tax. So you have to give a thought. Whether is my CGT getting affected? Is my inheritance tax getting affected? Is my VAT getting affected? Income tax, corporation tax? Because you have to compare them. This is not a straightforward question. You have to compare also. You should be able to compare also. But the question will guide you on which taxes you have to consider. Okay. So if there are any no's to the requirement, you should consider it very carefully. This is from the exam point of view. And in this type of question, it is likely that some information will be provided to you. Okay. So any information that is provided and does not need to be recalculated. You don't have to recalculate them. They have given you. Now, so we compare income tax, corporation tax, and national insurance. To consider whether an individual should operate as a sole trader or a limited company, it is necessary that you have to consider each option separately and you have to calculate the total tax, NIC, that is due under each and then compare them. A sole trader is subject to class 4 NIC. So he's subject to class 4 NIC and income tax on the tax adjusted profit after the personal allowance. But a director of a limited company is an employee, therefore he'll be liable to class 1 NIC and income tax on any salary and dividends. And the limited company, remember this is the director of the limited company, the limited company will be liable to corporation tax and employer's NIC. But the director's salary and the employer's NIC, they are deductible expense for corporation tax. That means while calculating corporation tax, you can deduct this as an expense. So, example 12. Here, Aragon is self-employed, prepares accounts to 31st March, considering incorporating his business through a limited company with effect from 1st April 2024. If he continues as a sole trader, tax-adjusted trading profit is given as 60,000. But if he incorporates, then tax-adjusted trading profit before the director's remuneration is also 60,000. He would pay himself gross director's remuneration of 15,000, dividend of 35,000, with the balance of profit remaining in the company. So now we are going to calculate the tax liability if it's a sole trader versus tax liability if it's operating as a company. So let us do example 12. So first we are going to find the tax liability as a sole trader. Sole trader tax, always write what you are calculating for. The subheadings, the headings are very important in tax. Okay, you are preparing for whom, the date, the year, and all this matters a lot, and what type of tax you are calculating. Rather than writing just tax, if you're writing income tax, write income tax. If you're calculating corporation tax, you have to write corporation tax. So now we are going to calculate, since it's sole trader, what does sole trader pay? Income tax, tax on their income. So we have been given one type of income only in this, that is your trading profits. So trading profit is 60,000. From here we are going to deduct personal allowance. Since trading profit is less than 100, full personal allowance. Now I'm going to do the sum function. See how in corporation tax you need the knowledge of income tax because the taxes are related. Now this is more than the basic. So the first 37,700 would be into 20%. And the balance, that is this minus 37,700. This would be at the higher rate, 40%. And now we'll add up the two. So this is your income tax, 11,432. Now we are going to find class 4 NIC because he is a sole trader, self-employed, class 4 NIC. Now you need the knowledge of your NIC. And you also need to know what NIC they will be, what class. So class 4 NIC. How is it paid? 60,000 is more than the upper limit, 5270. So you have to pay the additional 2% also. First, it is the difference. 5270 minus 12,570. Difference between upper and lower. This is into 6%. Then 60,000 minus 50,270. Your income minus the upper limit, the excess, would be taxed at 2%. Always round the figure, drop down the decimal, and add this. I'm going to do the sum function. So this I'm going to drop the decimal. It's 2457. Okay, now this is your NIC. What's next? So if you find the total, okay, your income tax plus your NIC. So this is your total income tax and NIC, 13,889. Okay, now you have to see which factor will help you to decide the net income that is remaining after tax and NIC. So net income after tax and NIC. So here, this is your net income. Deduct the income tax, deduct the NIC. 46,111. This I will highlight it. This you have to compare with the trading income. Now we will calculate tax liability as a limited company. So now limited company. Now when it's a limited company, you have to calculate what? One is the corporation tax for the company, the other one is the Aragon's. So Aragon's income tax you have to calculate. Okay, is income tax because he's receiving salary and dividend from the company. So on him we have to calculate the income tax of salary, dividend. What is the salary? 15,000. So if it's a company, rather than taking this 60,000, he's apportioning 15 and 35. As he's taking 15,000 as salary, 35,000 as dividend. Now the total income. Sum function is 50. So here now you have to deduct your personal allowance. Total income is less than 100. So full personal allowance you will get. That we are going to do sum function. Now if you see this is more than your basic, no. Your basic is 37,700. This is 37,430. Okay, sometimes when the numbers are very close by, it's easy for you to get confused. Okay, read the number properly till the end. 37,430. So everything will be taxed at the basic rate. Is it? No, this time you have dividend. Okay, this will be charged differently and this salary. Remember, when we are deducting the personal allowance, this is deducted from salary, which is your non-savings. Okay, so now from here we are going to deduct the personal allowance and take at basic rate 20%. Now, then 0, because 500 of dividend would be taxed as 0, but you have to show it, of course. Then the balance of dividend, from here we'll deduct 500. This would be taxed at the basic rate because everything is under basic rate. What is the basic rate of dividend? 8.75. So I'm going to drop down the decimal, keep it as a whole number. Then find the total income tax. So you see, this is your income tax here. Now, he's an employee receiving salary dividend. Which NIC? Class 1 NIC. Okay. Class 1 NIC. So when is he paying class 1 NIC? Remember that class 1 NIC is on salary only, not dividend. Dividend is not taken as an earned income. So 15,000 is less than the upper limit, which is 5270, but more than the lower limit, which is 12,570. So the difference would be at 8%. So here it's just minus the lower limit 12,570. Since this is class 1, it is at 8%, not 6%. It is class 4 that is at 6%. Is the difference. In tax, we don't work in decimal, it's a whole number. Okay. Now, there is a employer's NIC, but remember, employer's NIC would be paid by the company, not by Aragon. But still we'll keep it, calculate and keep it, because when we calculate corporation tax, that time we need this to deduct it from there. Okay, since we don't have any benefits in kind, so there is no class 1 NIC, class 1A NIC, only employers class 1 NIC. This is the difference between salary minus only one limit more than 9,100. Straight rate, one rate 13.8%. This is how employers NIC works. You can watch my NIC lecture, by the way. So I'll drop down the decimal, 814. Now, done. Now we will be moving on with the corporation tax. If he is operating as a company. So the tax adjusted profits. Tax adjusted profit is given as 60,000. I'll write in the next column. Here I'll do the working. Now, deduct. Remember the director's salary and all, you can take as an expense. Okay, the director's salary and employer's NIC. So salary 15,000, NIC 814, employer's NIC. Now, So this will deduct 44186. This is your TTP, taxable total profit. Now you have to pay tax. At what rate? This is which financial year? 2025. So there are two rates for financial year 2024. Small profit rate 20 and main rate 25. If you see this TTP, it's less than 50,000. So we are going to apply the small profit rate, that is 19%. So this we will tax at 19%. 19% into your TTP. So 8395. Now, so because it's operating as a company, we need the total tax NIC. That is your income tax plus class 1 NIC plus employer plus the corporation tax, which is, so you have to add four things: your income tax, your class 1, employees class 1, and the corporation tax. This is 8395, which is 12909. So this is the total tax under the company. Now we are going to find the net income. So when you're finding the net income, it is, remember here, it is your total income minus what do you have to deduct? The total tax and NIC paid under limited company? No. You have to deduct your income tax and you have to pay employee class 1 NIC. Net income for Aragon we are finding. This is net income for Aragon. We don't want employers, class 1 employer NIC and the corporation tax because they are company's part. Company will deal with them, not Aragon. Aragon is not going to pay those tax. But the total cost is this. Okay, just in case you have to compare. If you see it's 13,889 under sole trader, under company the cost is less, 12,909. And if you compare the net income, now you can compare the net income for Aragon versus if he operates as a sole trader. So which is better? You see here it is 46,111, here it is 46,301. Even though the difference is not so much, but he's better off if he's operating as a limited company. Isn't it? Now, if you see in terms of retained profits in the company. So what is the profits? Retained profits. If you want to find the retained profits in the company, okay, it is from here your TTP, taxable total profit. From here we are going to deduct your corporation tax. This is for company, remember, and we are going to deduct what's next? The dividend. Okay, the 35,000 dividend that is there. So dividend and corporation tax will deduct from the TTP and get the retained profit, which is 791. So there's a tax saving for Aragon if he's incorporating his business. That means working as a limited company. Just compare the total cost, 13,889 versus 12,909. Okay, if you compare the net income also, It's higher if he's operating as a company. But one thing you have to see when you're calculating employers NIC, employees class 1 NIC here, there is an annual allowance of 5,000 employees annual allowance, but in this case it is not available. Why? This is not available when the director is the sole employee of the company. Okay, so here Aragon, if you pass, so we are assuming Aragon is the director. He's the only person working there, one employee working. That's why he's not getting the allowance, employer's allowance. So now we will be moving on to example 13. With this we finish example 12. Example 13. Again, choice of a business medium. So Naren is self-employed, continues to trade. Trading profit has been given as 85,000. Okay. Trading profit has been given as 85,000. Now, based on this figure, they have calculated the income tax and NIC 24,389. Most of the students, they start going back to the taxable income trading profit. They go and start calculating tax to see whether this figure is correct or not. Don't do that. It's a waste of time. Whatever the figure they have given the correct figure. You have to go by that notion. Now, he wants to incorporate on 6th April. So the forecast TTP is also given as 85,000. This is after paying corporation tax. After paying corporation tax, he will withdraw all of the profit by paying herself dividend. Okay. So now, this question is similar to the previous question, right? What do you have to do? Let us first find the corporation tax. Okay. So here, you see it's 85,000. It's above the 50,000. So main rate 25% corporation tax will apply. And remember, if you see the 85,000, this 85,000 is between the 50 and 250, upper and the lower limit. So you are eligible for marginal relief. Okay, so now 85,000 into 25%. Now marginal relief, MR, you have to deduct. How are you going to calculate the MR? See, in this case, your TTP will be equal to your augmented profit because you have not been given the information about dividend. How much is the dividend? So now it will be 250, the upper limit, minus your TTP 85,000 into the standard fraction 3 divided by 200, 2475. So you have to deduct this minus this, your marginal relief. So your corporation tax is 18,775. Now, so how much he will able to withdraw as dividend? First, you have to find the corporation tax to find the dividend. Why? Because after paying corporation tax, he will withdraw all of the profits by paying herself dividend. That means from your profit, you have to deduct the corporation tax. So what was your profit? 85,000. Now deduct the corporation tax. 66,225. So this will be her dividend. Nothing is retaining. So now what do you have to do? Calculate income tax. This is the dividend income. So from here we are going to deduct personal allowance. This is higher limit, right? Since it is dividend, first 500 would be taxed as 0%. I'm going to write 0. First 500 as 0, then the balance. So from here we are going to deduct 500 and the basic rate limit. Right. It is 37,700 minus 500. This would be taxed at the basic rate 8.75%. Because the basic is 37,700, you have utilized 500, so you are left with 37,200 to be taxed at the basic rate. Now the excess would be taxed at the higher rate. That is this minus 37,700. So put a bracket because I'm going to multiply now. The whole thing needs to be multiplied by the higher rate 33.75. See, it's very easy to use 20, 40, 45%. Okay, always make sure which type of income you are calculating the tax on. Is it non-saving, savings, or dividend? Okay, because if it's dividend, the rates are different. It's very easy for you to make a mistake in this area. That's why I'm just warning you. Now, total. So 8640. This is the tax liability. Now, you need to find the total tax cost. This is income tax. See, this question is very tricky. Okay. First, you had to find the corporation tax so that you can find the dividend, and from dividend, we are finding income tax. Now you have both the tax. So now you can find the total tax cost if he incorporates the business. So now, if you see, this is the corporation tax. Plus the income tax, the two taxes. Okay, this. So you have been given the total income tax and NIC if he works as a self-employed. That is 24,389. This is already given. You have to find if he operates as a company, what would be her total income tax and NIC. That is this. So just compare the difference. Here they have given you 24,389. It's here. $24,389. 24,380. So this if he works as a sole trader, this if he works as a company. Okay. So which one is more? If he works as a self-employed, the cost is less. Can you see? What is the difference? 3,026. He has to incur more 3,026 cost if he's operating as a company rather than a sole trader. And after you calculate, do not just leave the calculation like that. You always have to give a conclusion. Where the cost is more, which one is more, which one is better. You have to give your own conclusion at the end. For that conclusion, there is 1 or 2 marks extra you are going to get. So this is the answer for example 12, where we have got the total tax and also net income after tax and NIC. 46,111 if he's operating as a sole trader, and 46,300 if he's operating as a company. So the conclusion is it is better to operate as a company because the costs are less. Example 13. So here also we have done, first we got the corporation tax, got the dividend. Once we got the dividend, calculated tax. So we added both the tax and deducted with the number which is given to us in the question to find what is the tax saving. That is 3026 if he works as a sole trader. This figure is already given in the question. We have to find a figure similar to it to compare, for which we needed the total tax of NADA. That's why we calculated corporation tax and income tax. But we cannot start with income tax first because our income is dividend. So we needed dividend first. To get that dividend, remember from profit, we deducted corporation tax and got the dividend. So that's why we first started with corporation tax. This is what I needed to tell you here. You need to be very smart enough to tackle with this type of questions. Some questions are very straightforward. You straight away know, like example 12 is very straightforward. Calculate income tax, NIC, corporation tax, one after the other, line by line, and compare. But example 13 is little tricky. Most of the candidates struggle to identify what is the starting point. Where do I start? With what do I do? How do I calculate my dividend income? They don't know that they have to start with the corporation tax. This is what they don't know. This is your starting point because one is related to the other. If you do not find the corporation tax, you can't find the dividend, then you will fail to find income tax. Hence, you cannot compare anything with 27,415 which is given to you. I'm sorry, 24,389. This figure is given. This you have found 27,415. So in this case, it is better to operate as a self-employed rather than company because the cost is more. Now, moving on. So incorporation has some tax advantages. For example, if you see the corporation tax rate on profits remaining undrawn within a company is a maximum of 26.5%. Maximum. But this figure will vary slightly if the company has dividends. But if you compare this with the sole trader, the highest rate they have to pay is 45%, which is the additional rate tax. So compare the two rates. Which one is better, 26.5 or 45? Both sole trader and partners have to pay 45, highest. Now, so when it comes to decide whether you have to extract a bonus as a salary or by taking dividend, which route is better? The dividend route has traditionally been optimal. If you see, the dividend route is considered to be better. Why? Because there are lower rates of tax on dividends. If you see the highest rate, that is 39.35 compared to 45. If you take salary, you have to pay 45%, the non-savings rate. And also in dividend, you are going to get nil rate band, where the first 500 of dividend would be taxed at 0%. This is not available for salary. And also dividends are not subject to NIC. So there are three benefits of you taking the dividend route. However, this may no longer be the case. Sometimes you might be an additional rate tax paying. You might be having such a high dividend that you're not going to get any benefit out of it. Sometimes the if you compare the salary and the dividend, the difference is not so much. Okay, so in that case, you can have a choice. But if the difference is very significant, you can very easily make the decision. Okay. Now, example 14. So let us go through example 14, salary versus dividend. This question is also a very famous question. It often appears in your past paper. So here seen is a director, the sole employee. That means he's not eligible for 5,000 employers allowance and 100% shareholder. He wants to take a bonus of 20,000 either as a salary or dividend. Now, seen is a high rate taxpayer. Okay, having already taken director's remuneration of 50,000 and dividend of 30, the dividend nil rate band has therefore been utilized. That means he have utilized that nil rate band before. When he was having the dividend as 30,000. Now, so if it's director's remuneration, we'll take the cost. Okay, let us say 20,000 we are taking as a salary. So based on this, we have to pay class 1 NIC, director's remuneration. Employers class 1 NIC. How much? So it would be 13.8% of this. This are deducted in calculating the trading profit. Okay, this is 2760. If you take 13.8 of 20,000. Now, the amount of corporation tax payable will reduce either at 19 or 25 or 26.5 depending on the augmented profit. We don't know. So the tax saving would be either could be this, this or this depending on the profit level. How? So just now the NIC cost was 2760. This is given here. Okay. So this cost 2760 we will be adding with the salary. That's how you are going to get 22,760. This could be taxed at 19% or 25 or 26.5. So if it's calculated, it's 1564, 293, 30 or 3271. They have already calculated and given. You can calculate and see are you getting this figure or not. Because it's a higher rate, he will be chargeable to 40% tax and employees class 1 at 2%. So this liability will increase 40 of income, 2% of NIC, 42% of 20, 8,400. So the tax cost could be this, could be this, could be this. Okay, because we don't know the corporation tax limit. Could be 19, 25 or 26.5. Based on that, they are adding this 8,400. For example, if 8,400 is added with 1564. Okay. Sorry, these are tax saving. They have compared. You have to calculate the tax and then add with this income tax. So corporation tax will be adding with income tax and find and deduct it from your director's remuneration, that is 20,000 salary. So then this will be your net cost. Now, dividend. If pays dividend. Okay. On company, no corporation tax, no NIC. But for scene, he has to pay tax of this on the extra 20,000 dividend. Because he's a high rate taxpayer, so 33.75. Remember the 500 was already utilized because before he had received dividend in the same year. So therefore, whether the dividend alternative is preferable will depend on the rate of the corporation tax that is payable. We don't know what is the corporation tax payable by the company. Based on that, we can say whether dividend would be preferable or not. In this case, it looks dividend is better because dividend is less costly. 6,750. If it's 6,750, it's better. But if here, see, depend on the corporation tax. Now, other factors you have to consider. Even though there are tax savings that you can get from operating as a company, but there are other administrative burdens of operating as a limited company, like legal responsibilities of being a director. Remember, when you're answering, you have to bring out these factors as well, not just the calculation part. They will ask you both. So legal responsibility of being a director, administrative burden of submitting your accounts, unable to use cash basis, required to register as an employer to operate payroll, even if only for themselves, and provide a pension scheme, and paperwork will be required for board minutes around dividends even if they are the sole shareholder. So that's it. We have touched on income tax as well, that is section A and the self-assessment part. So we have talked about IXBRL. This we have covered in this lecture. This applies to companies. Then the time limits, the penalties, the interest for filing late returns, for failing to notify HMRC, making late payment, and how large companies are required to pay on installments on a quarterly basis. Then list of information that you have to retain. Then we touch on the section E, that is corporation tax. So here we defined period of account, accounting period, financial year. Then we recognize when an accounting period starts and when it finishes. Then we computed tax liability and applied marginal relief. This is unique. So let us summarize. A period of account is when you're preparing the accounts. Okay. Accounting period is the period for which a corporation tax is charged. It's charged on the accounting period. Okay. So the financial year runs from 1st April to 31st March. If your financial year is 2023, because it's 23, it starts from 2023, 1st April to 31st March of the next year. So the rates are set for the financial year. Now, companies pay corporation tax on their taxable total profit. And sometimes they might have two period of account, two accounting periods. Okay, their period of account might be divided into two accounting periods, especially if they are having more than 12 months. So the first set of accounting period would be for the first 12 months. The second is the balance. Okay, and capital allowances are also calculated separately for each period. Then an accounting period must begin when a company starts trading or immediately after the end of the previous accounting period. Then accounting period must end either 12 months after it commenced or earlier at the end of the period of account. Now dividends are paid out of profits after tax. That's why you need the tax. That's what we have done in example 12. Example 13. We first found the tax, corporation income tax. Okay. Now a shareholder, which is a company, has no liability for tax on dividends received. It is exempt. If a company is receiving liability, a dividend, it's not taxable, exempt. Penalties automatically will apply for late or incorrect returns and failure to keep records. Penalties for late submission will depend on how late you are and the number of consecutive offenses. Interest will run from the due date to the actual date of payment. And a single penalty will apply for all the incorrect returns for all taxes. This penalty depends on the reason for misdeclaration, whether disclosure was prompted or unprompted. I would advise you, please watch my lecture 11 because their detail is provided there. Same detail is required here. That's why I have not repeated it here. So that's it. The technical articles. There are no technical articles for this lecture. Thank you for watching, and I shall see you in the next lecture. That is also continuation of corporation tax only with another part under corporation tax. Thank you for watching, and do not forget to subscribe to my channel. If you haven't subscribed, you can watch all my lectures under my tax playlist. Thank you.